The average American right now is struggling to make ends meet. Housing prices are sky high. Food prices have gone up, and even gas lately is also going higher and higher and higher. And all these economic indicators that you hear about are pointing toward a recession and a hard landing. So the question becomes, why haven't we had a crash yet? I'm going to explain why we haven't had a crash and when the probabilities are highest based on all these powerful economic indicators that we'll most likely see one. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over something called the lag effect with the Federal Reserve increasing interest rates. We've got a chart going all the way back to 1981 to today's date. On the left, we go from 0% up to 25%. This represents the overnight rate set by the Federal Reserve. So whenever you hear in the mainstream media them talking about Jerome Powell setting interest rates or raising interest rates or lowering interest rates, they're talking about the Fed funds. And it's represented by this blue line. So we go back to 1981, Paul Volcker. As you guys remember, interest rates almost at 20%, but then they take them lower and lower and lower. But what I really want you to notice with this chart is every single time that they raise rate, they go through a rate hiking cycle, is what we call it, with the exception of 1985. And I'd point out all these other economic indicators, like the inverted yield curve, were not pointing toward a recession, crisis, or a crash. So back in 81, we did have a recession. That's indicated by this red bar. But what's interesting is from the time the Fed paused, stopped raising interest rates, it took 6 months before we got the official recession. And let's fast forward to the recession that we had in the early 90s. When the Fed paused, it took 15 months. Dot-com, 8 months. GFC, 17 months to actually have a recession once the Federal Reserve paused interest rates. Let's not forget about the cerveza sickness. It was 10 months there. And as most of you know, the Fed has been hiking at their most aggressive pace going all the way back to the 1980s. We're about 5.25% right now. So there's kind of a debate out there as to whether or not they will continue to raise rates. But let's assume for a moment they don't. So they hit that pause. Well, then the next question becomes, okay, well, if there's this lag effect between interest rates moving up and that actually playing out in the real economy and creating a recession or a crash, how long is it going to take this time? But before we get into when the probability is highest that we will see a recession, crash, hard landing, etc., we need to understand the dynamics at play behind the scenes. Why do we get this lag effect? And once we understand why we get the lag effect, we can combine that with some powerful economic indicators and conclude how many months it's going to take us this time before we hit that economic wall. Step number 2. Now I'm going to reveal why we get this lag effect. And to do so, we're going to go right to the internet to a website called realinvestmentadvice.com. Now, bear in mind, I'm not giving you investment advice. That's just the name of the website. And this is a blog post from Michael Leibowitz, who I believe creates a lot of content with my good buddy Adam Taggart over at Wealthion. So you know this is going to be top shelf. He starts by saying changes in interest rates only impact new borrowers, including those with maturing debt who must reissue debt to pay back investors of the maturing bonds. We call it rolling over the debt. Accordingly, higher interest rates do not impact those with fixed rate debt that is not maturing. Now, I would disagree with that slightly because this is mainly applicable to people who own a home and have a 30-year fixed rate mortgage. But the fact of the matter is that if the interest rates are higher and higher and higher, it impacts the people that are potentially buyers for their house and therefore increasing or creating demand for the existing housing stock that definitely plays into how much home equity they actually have. And if their home equity is going up, they'll likely have more purchasing power. If their home equity is going down, then they will have less purchasing power. So, in an indirect way, I think that higher rates actually do impact those, even if they have fixed rate debt. But you've got to compartmentalize each group based on how quickly they have to roll over that debt. That's the main takeaway here. Getting back to the article, the lag effect occurs due to the time it takes for the new debt issuance to bear enough weight on the economy to slow it down. So there's two groups that I want to focus on here. Let's focus on corporations and then we'll focus on consumers. So looking at corporate debt specifically, in aggregate, higher interest rates are currently helping corporate borrowers. And this is where it becomes very counterintuitive. But they explain this by pointing out many companies borrowed heavily in 2020 and 2021 at very low interest rates, and the proceeds remain in deposit accounts, earning more than the interest on the debt. Consequently, net interest is actually reduced. So, this is fascinating as to how this played out in real life. So, if we think about it, we go back to 2020 and 2021, all these corporations thought the world was ending. I mean, the sky was falling. We had the cerveza sickness. People were locked up in a cage. It was complete madness. So, they went out and borrowed as much as they possibly could. Let's say they borrowed at a 3% interest rate, and then they just wanted some dry powder to survive a rainy day or rainy month or rainy year for that matter. So they took that dry powder cash, put it in the bank, but now that the interest that they're receiving on those deposits in the bank is, let's just say, 5% for the sake of this example. Okay, they borrowed at 3%, but yet they're receiving 5%. So that's 2% that goes right into their back pocket. So in this example, their interest payment would actually be negative. It would be negative 2% because they're paying 3% and getting 5%. But it's not all sunshine, unicorns, and rainbows, because at some point in time, they will have to roll over that debt. Let's say in a year, 2 years, 3 years, etc. And when they roll over that debt at a higher interest rate, that's when the rubber meets the road. But it's just a great example as to how the Fed's interest rates have actually helped the corporate borrowers instead of hurt them. But this isn't going to last forever. And in the next chart, we can see this phenomenon is nothing new. We go all the way back to, let's just say, the early 1980s. And you can see in that pink shaded area, that's the Fed raising rates, indicated by this black line. But you'll notice the net interest cost these corporations are paying actually went down as the Fed was raising rates. But once the Fed paused and actually dropped rates, that's when the corporate net interest cost skyrocketed. And you can see it right here on this chart with the yellow shaded areas. And that red line indicates those costs that have to be absorbed by the corporations, which would definitely impact profitability and potentially could push them over the edge into actual bankruptcy. This happened in the early 80s. It happened before the dot-com bust. It happened before the GFC. And it happened even before the cerveza sickness. So I don't know why there would be any reason why it wouldn't be happening as we speak today. So now that we know what's happening with the corporations, let's start focusing on the consumer, the average Joe and Jane. We go back to the blog post. They say currently mortgage rates are well over 7%, about 4% higher than the lowest mortgage rate seen in early 2022. Despite the sharp increase, the weighted average rate has barely ticked up. Only those buying houses are affected by new mortgage rates, and there aren't many home buyers. Now, pay very close attention to this next sentence. Existing home sales are at levels last seen during the depth of the financial crisis. In other words, demand for houses is basically at an all-time low. All right, so let's think this through. If demand is at an all-time low, and we do have very short supply, all we would need to see is a slight increase in supply, so prices of the entire U.S. housing stock would come down quite dramatically. So it is true that if you have that 30-year fixed rate mortgage, directly you are insulated from these higher interest rates, but indirectly you're not, because it's impacting those buyers, and that's going to impact prices, which impacts your home equity, which impacts your purchasing power, which impacts the overall economy. But unfortunately for the consumer, it's not just about mortgage payments. Let's think about auto loans. So going back to the article, they say that the average length of car ownership is 79 months, or just over 6.5 years. So every single year, you're going to have more and more people that have to buy a car at a much higher interest rate, which means they can afford a lot less. And don't even get me started on credit card debt. As most of you know from watching my videos, credit card debt lately has been exploding higher. And interestingly, there's an inverse relationship between the amount of credit card debt that's being taken on and the additional savings that we saw from the government stimulus checks. We'll save that for a separate video. But let's think about the interest rates on all this credit card debt that adjusts most likely every single month. Well, since Jerome Powell has increased rates from 0% all the way up to 5.25%, these credit card holders are seeing their monthly payment absolutely skyrocket. And if their monthly credit card payment skyrockets, that means there's a lot less money to buy other stuff. Aggregate demand goes down. This creates a further economic headwind, which could exacerbate a recession and turn it into something that looks a lot more like a crash. So let me go over this on the whiteboard to make sure that everyone's on the same page. It's actually super simple. We're going to use 3 individuals here that represent the U.S. economy. First and foremost, we're going to start with everybody's favorite, Moody the millennial, and their blue hair. I always have to catch myself because I know the millennials get super, super pissed off if you use the wrong pronoun. And I don't know Moody's pronouns, so I always have to make sure I say their blue hair. But anyway, Moody represents the bucket of consumers that are really impacted almost immediately by higher interest rates because they have a lot of credit card debt, as you would imagine. But they've gotten a big break because they haven't had to pay their student loans. But as you guys know from watching my videos, that comes to an end in October. The next group is the corporations. We'll call them the corporate clerks. So corporate clerk loaded up on debt in 2020 and 2021 at a very low interest rate. Now all that cash that's parked at a bank, he's getting 5%, pocketing the spread. But he is also going to feel the pinch when he has to roll over his debt, not monthly, like Moody the millennial, but let's just say every 3 years. So if he borrowed all of that money in, let's say, 2021, he's going to have to pay the fiddler come 2024 or moving into 2025. And the last segment that we've got is Boomer Bob. He's there, probably got a hurt back, I guess. He'd have to walk around in a cane, looking a little frail there. But he is pretty stoked because his debt is a 30-year fixed rate mortgage. So he doesn't have to roll that over for a long, long time. But unfortunately, Boomer Bob has almost 100% of his net worth in his house. So if demand for housing goes down because of the higher interest rates, that could definitely impact his spending and therefore the overall economy. So now that we understand how this works with Moody, Clark, and Bob, it becomes crystal clear as to why we always have this significant lag between the Fed raising interest rates and a recession or an economic crash. Step number 3. Now let's go through when specifically the probabilities will be the highest that we will see this economic crash that a lot of these indicators are pointing towards. In fact, we're going to go over some very powerful economic indicators right now, going back to this chart that we went over in step number 1. So if we add up the lag effect from every single recession going back to 1981. Basically, it's pretty easy math. Even I can figure this one out. So if you just add up these numbers, divide by 5, you get on average about 11 months. Once the Fed pauses, that's when the proverbial stuff hits the fan. Assuming the Fed has already paused, that would take us to June of 2024. But let's remember, I don't think this is the most powerful indicator. That would be the yield curve, and more specifically, the inversion of the yield curve. So if we look at the 3-month and the 10-year, this inverted back in October of 2022. And on average, we see about 14 months between when that curve inverts and the stuff hits the fan. This would take us to December of 2023. So if we kind of average these two out, that takes us to March of 2024. But unfortunately, there is a curveball. Editor, go ahead and throw up a chart of GDP plus. Now this is very interesting. This is a combination of GDP and GDI, gross domestic income. And this is from the Philadelphia Fed. And we can see that pretty much every time this goes negative for 2 quarters, we are already in a recession. So the next question becomes, well, what has it done lately? The answer is we have had 2 quarters of negative GDP plus growth, which would indicate, based on this very, very powerful metric, that we are already in a recession. So the bottom line here, guys, is whether we're in a recession now or we go into one in December of 2023, March of 2024, or June of 2024, it really doesn't change the fact that the probability is extremely high that we do experience a recession or an economic crash, a hard landing, within the next 6 to 9 months. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.